Welcome back. The U.S. Fed begins a two-day meeting today and could signal tomorrow that a first rate cut is coming or likely to come in September. But our next guest believes investors will be disappointed at the pace and number of rate cuts the Fed will have delivered by the time 2024 is over. Our guest is a former economist at the Fed. Vincent Reinhart is now chief economist at Dreyfus and Mellon. Vincent, thanks a lot for joining us. I believe your view on this is that the U.S. economy is stubbornly strong and will not require the number of rate cuts that the market is hoping for. Is that correct?
That's right. And in fact, it's not just stubbornly strong, it's baffling strong to the Federal Reserve, who've been expecting a slowdown. And I would point out that the same analysts who are talking about imminent substantial rate cuts by the Federal Reserve were also the ones that have been predicting off and on for the last 2 years that the U.S. was about to stumble in a recession. Hasn't happened yet. They were over their skis about the economic outlook. I think they're over their skis about the Fed outlook. Do you expect a rate cut in September? And if so, what is the Fed responding to if it delivers that September rate cut? So if the Fed delivers the September rate cut, which is a little bit better than a coin toss, it means it's working according to its plan. Its plan is to readjust the nominal policy rate to the lower prevailing level of inflation. That's not, this month's inflation or that month's inflation. The fact is at 5.25%, the funds rate is high relative to where we are right now. And so they're going to cut the nominal funds rate gradually over time to pull the real rate lower, all the while keeping policy in the restrictive mode to make sure inflation falls back to goal, but not so restrictive to risk turning the economy down and into recession. It could start in September if between now and then there's a little bit more evidence that inflation is meaningfully, assuredly lower.
Equity markets, of course, began rallying way back last fall when the Fed seemed to signal that it was pivoting from an emphasis on raising rates to the consideration of lowering rates. I believe you think that equity markets are pricing in what you call a breaking the glass scenario, like an emergency scenario where the Fed breaks the glass, pulls the switch, and delivers a series of rapid rate cuts.
Well, I think the problem is I have trouble understanding the screens you're showing in the following sense. If you look at Fed funds futures, if you look at the short-term term structure of interest rates, it suggests that market participants expect a lot of Fed easing soon and by a good bit, more than 0.75 percentage point reduction in the federal funds rate target by the end of this year. That's the sort of policy response you get when the Fed's in emergency mode, when it has broken the glass, when it has pulled the levers of emergency policy, reacting to data that is surprising on the downside. Right now, the Fed thinks it'll be cutting rates according to a plan to slowly restrict the amount of policy, to reduce the amount of policy restriction. In the break glass scenario, the Fed would be doing it because the economy is performing poorly, that there's lots of risks out there. There's a lot of risk out there, then please explain to me why the VIX, the implied volatility, isn't higher. Why aren't risk spreads higher? Why aren't equity prices lower than they are today? It would seem that interest rate futures, the short-term path through the Fed embedded in markets, isn't completely passed through to the rest of financial prices, because what would require the Fed to actually do that, to deliver that significant rate cut, is a poorly performing economy, and that wouldn't be good for us.
Do you believe equity markets are overpriced, and do you believe that they are set for a tumble once reality sets in?
I believe it's a losing game to make a call on equity prices. I do think that equity prices are not consistent with a lot of models of valuation, and that it seems to embed the best of both worlds, well-performing economy and the Fed delivering rate cuts of a significant amount. Not going to get both, and that suggests there's going to be some disappointment. What I'm a little more confident about is that tomorrow, when Chair Powell's committee makes its announcement and he gives his press conference, the Fed's not going to be as forthcoming promising rate cuts as markets currently hope.
Where are we in the soft landing debate? Are we headed for one? Are we in one? Or is that the wrong way to think about this?
I think soft landing is too precise for our understanding of the economy. It gives you this image of Tom Cruise trying to stick it on the aircraft deck during a storm. I think that right now the U.S. economy retains momentum. We can keep the airplane analogy going, and basically, it's only at risk if it starts slowing and gets closer to the ground. That basically, a recession is a nonlinear event like a wind shear. A plane is at risk when it's flying slower and closer to the ground. Right now, the U.S. economy adding almost 250,000 jobs on net each month, real GDP increasing 2.75% last quarter, on track probably for something like that this quarter, isn't flying low enough or slow enough to be significantly at risk. We're always at risk, but not significantly at risk. So the best bet is we keep going in terms of economic momentum, slowly flagging. Inflation, inertial, slow, will decline, get back to the Fed's goal. It's just going to take longer than a lot of people think.